Well, hello and welcome back to Principles of Accounting 1. It's your host, Dr. B. Happy to have you with us. We made it to the very end of the semester of the fall 2024 semester. There's only like 3 days left, something like that, maybe 2 days left of the actual semester. I think classes are ending pretty soon, is my understanding. So today we're going to talk about the statement of cash flows, and then we're going to talk about the final exam. But before we jump into those conversations, I do want to bring your attention to the classroom real quick. So, as you know, we are in the final week, which is the week 16, and I have it dated to the 13th, which is this coming Friday. This coming Friday. Technically, I think classes end up tomorrow, if I'm not mistaken, is the last day of classes. But I need you to have some time in order to finish your quiz, okay? Now, as you also know, normally I have a discussion board with the quiz, but you'll see that I changed this discussion board. It now says week 16 discussion, a gift to you. And it also says this last discussion has been canceled because we're at the end of the semester, and I think tomorrow's the last day of classes. And we got to get the quiz in by the 13th, which is this Friday. So, in order to make sure that we're all on top of our game, I decided to cancel this last discussion board. Now, as you know, the discussion board was worth 10 points. I didn't just leave 10 points out of your grade, I gave you 10 points. So that's a gift to you. Not only do you not have to do the discussion board, I also gave you 10 points. So consider it a gift from me to you. It is a bonus. It is a, it is a gift from me to you. So you don't have to worry about the discussion board, but you do have to worry about the quiz. So I need you to take care of the chapter 16 quiz by this Friday, not this Sunday, this Friday. Okay, so if you could knock that out on Friday, that by Friday, that would be awesome. If you could knock it out tonight, that'd be even better. But if you can knock it out by Friday, please do so. So you have 3 days. You have 3 days to take care of that chapter 16 quiz. That also means you have 3 days to complete any remaining work in this course. So, for whatever reason you missed a discussion board or a hypothesis, something along those lines, just make sure that you have it knocked out by Friday. Because, you know, technically the semester ends tomorrow, giving you a couple extra days. Classes end tomorrow, trying to give you a couple extra days. And then we got the final exam. Final exam I have dated for the 17th. That's next Tuesday. Okay, next Tuesday, final exam. You can take it now. It's open and available. Just want to let you know. But those are the two action items that you have due to me is the chapter 16 quiz and the final exam by the respective due dates. Now, again, you could do those early. I'm encouraging you to do them early, but those are the two remaining action items for this course. In addition to that, if you have past due work, that also needs to be completed by this Friday. So, having said all that, without further ado, let's jump into our last discussion of this course, and that's going to be on the statement of cash flows. The statement of cash flows is the last financial statement that we commonly deal with in business, and it's more of an analytical financial statement because it represents all of the cash coming into and out of the business. All it does is it tracks what's going on with your physical cash in the business. Cash comes into the business from our customers, through sales that we're making to our customers. Customers pay us in cash when they receive the goods and the services. Uh, you know, that's how we receive our cash. And then we pay the cash. Cash goes out of the business and we use it to pay our bills, our rent, our inventory that we need to purchase, our utilities, our employees, the day-to-day operations. So cash comes into the business from our customers and goes out of the business for our day-to-day operations. We call that operating activities on the statement of cash flows. It's cash from operations, operating activities. Operating activities would be the day-to-day operations of the business. I'm selling goods and services to customers, and they're paying me in cash. And then I use that cash to pay for the operating expenses, the rent, utilities, inventory, etc., repairs and maintenance. The list goes on and on. Operating activities. So the statement of cash flows is broken out into three different categories. We have operating activities, that's the day-to-day operations of the business, cash coming in from our sales and going out for our daily expenses. We have what we call investing activities. This is where we're investing in the business. We're purchasing or selling property, plant, and equipment. Investing, we're investing into the business. Purchasing or selling property, plant, and equipment. So cash would come in from the sale of property, plant, and equipment and go out for the purchase of property, plant, and equipment. See? So that's investing activities. And then we have financing activities. Financing activities would be like the business is taking out a loan at the bank. So that would be cash coming in because we took out a loan. The cash would go out, we repay the loan and the interest on that loan, right? And then we have other financing activities like we're issuing stocks to, we're selling stock, right? We're issuing stock. So somebody purchases shares of stock from the business, that's cash coming into the business for the purchase of the shares. You see? And then when we repurchase the stock, it's cash going out. So the statement of cash flows is broken up into three categories: operating, investing, and financing activities, for the reasons I just discussed. I'm going to show you what it looks like, show you how to read it, and how to analyze it. Remember, the reason why we talk about the statement of cash flows last is because it's really an analytical report. It's just showing us how we used our cash. It's the purpose of it. So let's talk about those operating, investing, and financing activities, and we'll just talk a lot about the statement of cash flows. So the reason why we have a statement of cash flows is because it shows a company how we receive our cash and when we're receiving it. And we're also showing the reasons why, what we're using cash for, what the balances are, etc. Those are the types of things that the statement of cash flows tells us. Why is cash flow so important, you might wonder? For the obvious reason, we need cash to run the business. So we need cash to be able to pay our expenses, our debts, our day-to-day operations, and to make investing decisions. That's what we need cash for. We need cash to run the business, right? So that's what it helps us do. And having a steady cash flow, cash coming in and out of the business, having that being steady, meaning, we have enough to be able to do these things, is really important. It's really important for the business. The cash flow helps us to measure our efficiency. It helps us to be stable. That's what the cash flow does for us. So we need to look at both what we call cash and cash equivalents. Cash is just cash. That's the currency, right? That's the paper money, the coin money. Cash, right? Checks, cash, it's all the same. That's cash. And then we have what we call cash equivalents. These are things that be quickly converted into cash. Cash equivalents includes things like short-term investments, stocks, yeah, that type of stuff. Those are short-term cash equivalents, quickly converted into cash. One thing that cannot be so quick that could be converted into cash is inventory. And the other, of course, is property, plant, and equipment. It takes forever to sell that stuff. So when you hear cash equivalents, think short term, and I could quickly convert it into cash. So example of that, of course, would be short-term investments. We need these things to be sufficiently close. If the short-term investment is quickly convertible into cash and is close to maturity, or so that its market value is not affected, we can convert it into cash. So as I had mentioned, the statement of cash flows is broken out into three categories: operating activities, investing activities, and financing activities. The operating activities are the day-to-day operations of the business. So that would be cash coming in from sales to our customers and collecting our accounts receivable from our customers. And it might also be like things like dividend and interest revenue. And then cash going out of the business would be for things like paying our day-to-day operating activities, like rent, utilities, salaries, wages, taxes, interest, and of course, buying additional inventory. So that's all operating activities, day-to-day operations of the business. Then we have our investing activities. That's purchasing or selling property, plant, and equipment. And then financing activities, that would be like taking out a loan, repaying a loan, issuing stocks, repurchasing stocks. Those are financing activities. So just keep those in mind because we'll go a little bit deeper on each one. So the first being operating activities, cash coming into the business, we call those cash inflows. And that comes from sales we made to our customers, collection of our accounts receivable, receipt of interest, receipt of dividends. And then we have our payments that we make on a regular basis, cash outflows. These would be our operating expenses like rent, utilities, repairs and maintenance, etc. Salaries, wages, interest, taxes, and of course, paying our suppliers or vendors for the goods and services. So we can see the cash coming in and the cash going out. Now, here's a real simple formula to remember. You're going to hear a term called net cash flow. Net cash flow. The word net cash flow, all it simply means is it's what's left over. It's the balance. Okay, so we have cash coming in, that's positive. Then we have minus the cash going out, okay, on the negative side. So cash coming in minus the cash going out equals the net cash flow, right? Cash coming in minus cash going out equals net cash flow. We calculate net cash flow for operating, investing, and financing activities. I'll show you a little bit more when we look at the statement of cash flows. On the investing side, the cash coming in comes from the sale of property, plant, and equipment, and other things like intangible assets and that kind of thing. Then we got cash going out of the business. We got purchasing property, plant, and equipment, other long-term investments, maybe even some short-term investments, those types of things. And then financing activities. Financing activities, as I mentioned, is the issuance or repurchase of things like stocks. We also have loans, which are notes payable, and bonds payable. So cash coming into the business comes from the company issuing stocks, bonds, or taking out a loan, or could be contributions from owners and other investors, etc. And cash going out of the business or financing activities would include things like repaying loans, repaying bonds, treasury stock purchasing. That all that simply means is repurchasing our own stock, paying dividends to shareholders, and owners' withdrawals. So those are all what we call financing activities. So the statement of cash flows is broken out in categories based off of those activities. As you know, there are a lot of connections between the financial statements. There's connections between the income statement, balance sheet, and the statement of cash flows. The way that the balance sheet and the statement of cash flows are connected are, of course, by the cash balance. The cash balance, as you know, is a current asset account on your balance sheet, and that tells us a lot about our operating cash flows on our statement of cash flows. On our balance sheet, we also have our property, plant, and equipment. Those are long-term assets, and that tells us a lot about our investing cash flows. And then on the other side of the balance sheet, we have our liabilities. Current liabilities, that's our comes from operating activities, because those include things like accounts payable, wages payable, taxes payable. Those are all current liabilities, right? And those come from our operating activities, day-to-day operations of the business. Then we also have our long-term liabilities, which would be things like loans, bonds, right? And of course, as you know, loans and bonds are part of financing cash flows. And also on our balance sheet, we have our equity section, as you know. And under equity, you'll find things like treasury stock and common stock, right? And owners' withdrawals and contributions. All of those things are also related to the financing activities on the statement of cash flows. So this shows you the relationship between the balance sheet and the statement of cash flows. Now, you may also see on the statement of cash flows what we call non-cash investing and financing activities. These are not very common, but they do occur. And it would include things like the retirement of debt by issuing stock. So I'm paying off a loan by issuing stock to the loan holder. I'm converting preferred stock into common stock. There's no cash changing hands there. It's just changing one form of equity to another. Leasing an asset or a long-term lease transaction, those are non-cash based. Purchase of long-term assets by issuing a note or a bond instead of cash. Exchanging non-cash assets for other non-cash assets. It's like a simple exchange for one thing or for another. It's like, oh, I'll trade you this car for this piece of land, or something like that. Right? That's just a simple exchange of assets, no cash involved. Now we have the purchase of non-cash assets using equity or debt. So again, cash isn't involved in these things. These things are relatively rare, but they do happen, and they are reported on the statement of cash flows. So how do we prepare a statement of cash flows? There's actually two different ways that we would do this. One is called the direct method, and the other one is called the indirect method. And I'm going to show you how to prepare both ways. So this is the simple format of a statement of cash flows. We call this the direct method. And what you can see here is we have the net cash flow for operating activities, the net cash flow for investing activities, and the net cash flow for financing activities. Remember, the way that we calculate net cash flow is we take the cash coming in minus the cash going out. That gives us net cash flow. And we do that for operating, investing, and financing activities to get the net cash flow for each category. Then we take that and we add it to any prior balance, and that gives us the ending balance for cash. Pardon me. So there is a 5-step process we use for preparing the statement of cash flows. The first thing we do is we compute the net increase or decrease in cash by looking at the overall change in cash. We take the cash coming in minus the cash going out to get the net cash flow. So we do that for each category. Step 2, we do it for the operating activities. Step 3, we do it for investing. Step 4, we do it for financing. And we add them all together to the beginning balance of cash to get the ending balance of cash. So that's the simplest way to prepare a statement of cash flows. So the first thing we want to do is really analyze the cash account. And to do that, what we do is we look at the cash coming in and the cash going out. So you may remember this. This is called a T account. I think we talked about this maybe the second week that we met. It might have been the first week. I think it was the second week that we met. So this is a long time ago, right? This is like 14 weeks ago. We talked about T accounts. And all a T account is it's a deep look in a visual way to look at our individual accounts on our general ledger. And so here we have the cash account for the company. And on the left side, that's how we increase cash coming in. So you see on the left side, we have a prior balance plus receipts from our customers, plus the sale of some assets, plus the issuance of stock. And I add all those up, right? And that's my debit balance. And then on the right side, that's all the cash going out of the business. So here we see payments for inventory, other operating expenses, interest, taxes. Those first 4, those are all operating activities. The second to last one, retirement of a note. That one is probably financing, and then we have dividends. That's also financing. So I add up all of my cash going out. I took my cash balance that came in minus my cash balance that went out, giving me the ending cash balance of $17,000. So it's really important that we understand the cash coming in and out of the business. On the side of cash coming in, we got cash from customers, that's operating, cash from the sale of assets, that's investing, and cash coming in from the issuance of stock, that's financing. Then cash going out for operating and financing activities. So now that we have an idea, we can further analyze our cash. The next thing we want to analyze, take a look at, is our non-cash accounts. And there's a really simple formula to calculate our non-cash accounts. And the way that we do that is we take our cash to find our cash balance. We take our liabilities plus our equity minus our non-cash assets. Your non-cash assets are all of your assets except for the cash account, right? So liabilities plus equity minus all your non-cash assets, they'll tell you how much cash you have in the business. It's just basically a way of working backward, right? Solve for X. How do I solve for X? I have to move all the other stuff on the other side of the equal sign, right? That's basically what we did here. Liabilities plus equity minus the non-cash assets. They'll tell us what our cash balance is. That's a way of analyzing our non-cash accounts. So once I've analyzed all of that, I can prepare the statement of cash flows. And I'm also going to look at balance sheets, my income statements, and any additional information to prepare my statement of cash flows. So I had shown you the direct method, which are looking at all of your net cash flows. So now I want to show you the indirect method for the statement of cash flows, which is a little bit more complex, but I'll show you the simplest way to get there. So as we saw with the direct method, it's all of the cash coming into and out of the business for your operating, investing, and financing activities. That first part, the operating activities, is really important because we need that to figure out our indirect method. So here we can see the cash coming into and out of the business for operating activities. We got cash that came in from the sale of $570,000 worth of goods and services, minus all the cash going out for our various operating activities: purchase of inventory, payment of wages and other expenses, payment of interest, payment of taxes. Gets me to my net cash flow for operating activities of $20,000. Now, in order to calculate the statement of cash flows using the indirect method, what we do is we take net income, which is found on your income statement. So at the bottom of the income statement is net income. We take our net income, and then we add and subtract our non-cash accounts. So that would be accounts receivable, inventory, prepaid expenses, accounts payable, interest payable, taxes payable, depreciation, and then other accounts, right? So we take our net income plus accounts receivable plus merchandise inventory plus prepaid expenses, and then minus accounts payable minus interest. I'm sorry, plus accounts payable plus interest payable, and then minus taxes payable minus depreciation expense minus the loss on sale plan asset plus a gain on the retirement of a note equals the net cash provided from operating activities. You see why we call it indirect method. It's indirect because it doesn't involve the cash accounts. So we take net cash flow, then plus or minus all these things that are not cash related. And what that does is it helps us to understand that our net cash balance from operating activities is what it's supposed to be. It's a way of verifying it. And this just shows us a nice graphical representation of the indirect method for the statement of cash flows. And then we can walk through the steps of applying the indirect method. So the first step, of course, is to look at the adjustments from the income statement items that do not impact cash. So changes that do not impact cash. And then the second thing we do is we adjust for the changes of current assets and current liabilities. And then that helps us to derive the net cash balance from operating activities using the indirect method. Not going to have you focus too much on it because it is a little bit more complex, but it's something that you should understand. So we make adjustments for the income statement that do not affect cash by looking at the expenses and losses that with no cash outflows. We also look at revenues with no cash inflows, and we subtract them from net income. This is just a nice table that shows us the impact on our assets and liabilities. Don't have to worry too much about this. It's just nice graphical representation. And the second step in the indirect method, of course, is to go through the increase and decrease to our current assets and current liabilities. And we also subtract all that from net income. And this is just a nice summary of how it works. So again, two-step process. First thing we're doing is we're looking at the operating items without cash involved. So we add in the expenses and losses and subtract out the revenues and gains. And then that's step one. And then step two is we add in the non-cash current operating and current liabilities and subtract out the decrease from current operating and current liabilities. And that drives us to the net cash balance. So this slide I like because it's just a really nice summary of the indirect method, and I think that this is probably the best slide to help you work through that formula. So that's operating activities. That's probably the most complex. We do this for the investing and financing activities. It's very straightforward. It's just the cash coming in minus the cash going out. For those activities. Very, very straightforward. Three-step process. First thing we do is we identify the changes related to accounts. Second thing we do is we look at the T accounts. And the third thing we do is report the cash flow effects. Again, it's just the cash coming in and cash going out for property, plant, and equipment when it comes to the investing. So here we have an example. We're looking at from year to year. We can see a significant increase in plant assets. That means we've probably purchased some additional plant assets. And I would expect to see that change. And these are some of the journal entries that stemmed from that change in plant assets. Looks like we purchased it using a note payable. And then it looks like we sold it at some point, and then we have the accumulated depreciation. And this just kind of shows you the evaluation of those T accounts accordingly. But it's really straightforward for both investing and financing activities. It's just the cash coming in minus the cash going out gives us the net cash flow for operating and financing activities. When it comes to the financing activities, we identify those changes related to finance. We look at the T accounts again, and then we report. So same exact type of process. Looking at the difference in years, we calculate the change, and then we go through that same process, evaluate the journal entries, look at the T accounts. And we would do that for everything related to finance. That would include things like changes in common stock, changes in retained earnings. And then one of the last things we do is we do what we call a proving of the cash balances. All this is that we're matching the actual cash balance to what we have reported on our statement of cash flows. And we can summarize everything using those T accounts that we learned about during the second week of this course. One of the other things that it's important to do, and what we've been doing throughout this course, is analyzing the financial statements. And one way that we do that is by calculating ratios. And one of the best ratios I personally like for this is the cash flow on total assets, which we'll talk about here briefly. So we look at analyzing our cash for a couple different reasons. Of course, management needs to understand it from an operating perspective. Our creditors need to know what our cash is like, cash flows are like, in order to make sure that we have the ability to repay our debts. And our investors need to understand what our cash flows look like, because it affects them when it comes to buying and selling stock. So, in looking at our cash flow to total assets ratio, we take our net operating cash flows, which is cash coming in minus cash going out for operating activities. Net operating cash flows divided by the average total assets. The average total assets is calculated by taking the beginning balance plus the ending balance divided by 2 for total assets. And of course, we can also look at it from a spreadsheet perspective in Excel. The spreadsheets in Excel are nice because it gives us an opportunity to manipulate the data to see what type of changes would affect our overall cash position in the business. Let's see. This is just another recap or similar framework on the direct method for the statement of cash flows operating activities. It's just cash coming in minus cash going out equals net cash flow. And that's just a nice summary slide. And that is the end of our conversation on the statement of cash flows. Are there any questions about the statement of cash flows before we jump into the final exam? Statement of cash flows, any questions? Statement of cash flows, going once, going twice.
And for me, it seems pretty solid. I get it.
Yeah, it's pretty straightforward for the most part. Don't worry too much about the indirect method a whole lot. That part can get a little confusing at times. But the good news is, at least for this course, we don't go too deep in the indirect method. If you are an accounting major, eventually you'll probably see that again, and that would be in your intermediate accounting courses. But okay, great. So without any questions on that, let me close that out and let's jump into the midterm exam. I'm going to start a separate recording, so just stand by.